CDG, how you doing? You've seen some advocate taking home equity. Oh, you've seen some advocate taking home equity, putting it in life insurance, whole life or IUL. You've heard that some life companies don't like that. Thoughts? Yeah, I mean, basically, if you're planning on doing that, there's no reason your life insurance company would have to know about it. But yeah, the life insurance companies in general, they like to see your premiums come from income or savings. Now me, I consider the equity in my home as part of my savings. So I don't tell my insurance company if I'm funding my insurance with a home equity line of credit. But that's what I did. I don't have a home equity line of credit right now because I refinanced. But that's what I did when I had my home equity line of credit. And I think it's a great use of funds. Oftentimes, your home equity line of credit can be a very low interest rate, possibly lower than what you could earn inside your policy. But you're basically you're using that equity to create a place where you're going to grow some wealth, and you're going to get compounding growth that happens for the rest of your life as soon as you get that started. And you can always take that value that's in your policy growing and pay off the home equity line of credit. So it's a very low risk way of approaching it as well. John Tran, how are you doing? You've been asking some good questions on my videos. Why does it matter to them, the insurance company? So it matters to them because I think your traditional designed whole life policies and IULs are kind of not really great products. The whole life especially. Like a typical whole life design, if I design it for all base premium, it's all whole life insurance, there's no blend, you're not going to have any cash value in the first couple of years. So what happens if you take out a home equity line of credit, you fund your whole life policy and have no access to that cash value, and then the housing market crashes, your bank doesn't let you borrow from your home equity line of credit anymore, you maybe lose your job because the economy is tanking, and now you have no way to pay back the home equity line of credit, you have no way to make your whole life insurance policy payments, and you have no access to the cash that you put into the policy. That's a recipe for disaster. And not that whole thing happens all the time, but people do get in trouble when they commit to too high of premiums in life insurance policies that are not liquid. So these terribly designed policies, people commit to paying too much, they stumble financially, and now that policy is a burden. And so they end up lapsing. The policy ends up lapsing. And insurance companies see this all the time. So they're used to encountering poorly designed policies that often lapse. So they have to be very tight in their underwriting. They're very tight in their financial underwriting. And they don't want people to get out over their skis. They don't want people committing to too much premium. Because they see it all the time where they just let policies lapse. Sometimes they just get tired of paying for them because they're not seeing the benefit from it. They keep putting money in and there's no cash value that comes out of it. I encounter people all the time, and it's frustrating to those folks to know that they're putting all this money out there and they were told how great this thing could be, but it's not great. And that basically comes down to how it was designed. Like these policies that I design and sell, people have 90% cash value in the first year. 87% cash value in the first year. It totally changes the conversation if people have access to that cash value and suddenly they stumble financially. Now it's not a burden. Now it's a product that can help save them. It can help them meet whatever their financial needs are. And everything just works better when it's designed for it. So I don't know why insurance companies continually make it so that people can design such horrible policies. I mean, I think it's just because they make money either way. People end up giving them thousands of dollars, and then their policies just go away. So I think that some of them just value that more than just having more happy customers. That's the only thing I can think of. And I know that there's agents out there that don't like to cut their commission down. You know, part of the design that I'm doing really minimizes the agent commission, typically by like 10 times less. So it can really substantially lower it. And the way life insurance is traditionally done, it might be hard for someone to make a living if they're not making that much commission. It works out fine for me because I don't do any marketing. I just do YouTube, and I meet with people via Zoom. My costs are very, very low. I don't go door to door. I don't buy leads. Oftentimes, insurance agents will buy leads in order to get clients, or they'll make cold calls all day long. They basically spend a lot of effort and time and often money trying to get in front of more people. And so they have to have a higher commission. I don't need to have that. And so I don't have to worry about designing the best policies for people. So, but yeah, I think it comes down to just the insurance companies. Their financial underwriting has to take into account that people are getting really poorly designed policies as far as their cash value or their cash flow is concerned. CDG, okay, you didn't know whether you really have to disclose where the premium was coming from or not. They have questions, but they're going to ask you where the premium's coming from. The premium's most often coming from cash and savings. If somebody, your client fills out the application, if they know that they're going to be pulling money from a home equity line of credit, I don't necessarily see that as having to answer yes to any of the insurance company's questions. So the insurance company asks you, are you going to be borrowing money for paying the premiums, right? And mostly that question is to meet premium financing. It has to do with premium financing. and that's not what we're doing. If somebody wants to borrow from their home equity line of credit, well, the way I treat a home equity line of credit, that's where I put all of my savings. So I don't view that as borrowing from somebody to pay the premiums. I view that as taking from my savings to pay the premium, because that's where I keep my savings. When I had my home equity line of credit, I kept my savings in the home equity line of credit, waiting to deploy it. Money in your home equity line of credit, if you're going to go out and you're going to invest, it's considered seasoned funds. The money in your life insurance policy is considered seasoned funds. There's not a whole lot of difference there. So I don't really worry too much about that as far as if somebody's pulling it from a home equity line of credit and they answer that question as no, they're not borrowing to pay it. Now, if they're going out and just getting a loan in order to fund their life insurance policy, yeah, maybe they need to be answering that question a bit differently.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.